All right, good morning, good evening, good afternoon. We are back, ladies and gentlemen. We are back. If you're new here, make sure to subscribe and hit that notification bell. We are here at Web3 Investing, where we make videos about Web3 investing, of course. Mostly we talk about Chainlink, but we talk about some other stuff too, like in this video, because I saw a lot of opinions from Web3 KOLs and just experts stating their reasons why they think they're in a bull or in a bear market, or we are in a bull or bear market. At the end, I personally think that it really depends on what time frame you are looking at, or like in what time frame you're looking at. But we can't deny that the overall sentiment right now isn't as great as used to be, as well as the Bitcoin price. There's a lot of altcoins that are way down than Bitcoin is, but or at least from their all-time high. But yeah, we can't deny that the sentiment isn't as great right now. But that's why we're breaking down this video as well, because I want to talk about the 5 critical triggers, in my opinion, of course, that need to align for a major next bull run. So everything in this video will be based on current market data, institutional flows, regulatory developments, and what's actually happening right now in early March 2026. And I'll try to keep it as neutral as possible and not go into pure raw speculation too much. So Bitcoin is currently trading at around $67,000, consolidating in a range between 60K and 72K after 5 consecutive red months from October 2025 through February. And we have seen a significant pullback from the highs, down roughly $20,000 from where we were a year ago. Some say that we might go lower, while others say that the market actually feels like it's coiling, building tension up before a major next leg up. So let's break down what happens or needs to happen to ignite this next move. So the first trigger would be sustained institutional capital flows through ETF. The whole ETF story is more complex than most people realize right now. We saw some inflows earlier this year, around $1.2 billion in just the first 2 trading days of January, and we're seeing renewed strength here with over 1.1 billion in weekly inflows recently, including $462 million on March 4th alone. And then you have BlackRock's iBit fund, which now holds 64.8 billion in AUM, which is pretty impressive. But from November 2025 through January 2026, we experienced 6.18 billion in net outflows, the longest sustained outflow streak since the products actually launched. And as you can see, the average cost basis of US Bitcoin spot ETF holders is still way above the current Bitcoin price. I think we need more sustained, consistent inflows rather than these, I guess, sporadic bursts. And when ETF demand stays positive week after week, it creates a mechanical buying pressure, because these funds must purchase actual Bitcoin to create those new shares. And with the exchange balances at multi-year lows and over 400,000 Bitcoin accumulated in the 60 to 70k range, you do have persistent institutional buying through ETFs that could trigger a supply squeeze that we haven't seen before. We need institutions doubling down, not rotating out, and we're starting to see small signs of this. Morgan Stanley actually announced that they would launch Bitcoin and Solana ETFs. When you have those major Wall Street players with $8 trillion in advisory assets entering the space, that kind of changes the structural demand picture entirely. Trigger 2, the second trigger, is the Federal Reserve pivot and the macro liquidity expansion. So let's talk about the master variable here, that's liquidity. The Fed held rates steady at 3.5 to 3.75% in January after cutting 3 times in late 2025. US inflation remains slightly above target with a core CPI at around 2.4% year over year. But what matters for crypto? Goldman Sachs expects rate cuts in March and June, bringing the Fed funds rate down to 3 to 3.25%. And the market is pricing in 2 cuts later in 2026. And critically, the M2 money supply after contracting is starting to expand again. There's also war in the world, war costs money. It's possible that they need to turn the money printer on to sustain these war efforts. Bitcoin has shown a correlation of 0.55 to 0.78 with the S&P 500 over the past weeks, and it's behaving like a risk-on asset. And the Fed's quantitative tightening is also winding down. Jerome Powell's term as the Fed chair expires on May 15, which is, I guess, next week. And President Trump already signaled that he wants someone more dovish on the rates to take his place. Multiple Fed governors are divided, with some pushing for more cuts, others don't. If we get 3 to 4 rate cuts in this year, combined with balance sheet expansion, that would create the liquidity backdrop that crypto actually needs. And without this trigger, we're basically fighting against the current. The third trigger is the regulatory clarity and the Clarity Act passage. This is actually a structural catalyst that most people are sleeping on. The Digital Asset Market Clarity Act has actually passed the House with a 294 to 234 vote back in July 2025, and it would establish a clear jurisdictional boundary or boundaries where CFTC gets digital commodities while the SEC keeps securities. And this also ends years of regulatory ambiguity. But it stalled in the Senate over one issue: whether stablecoin platforms can offer yield to their users. And the banking industry, or like the traditional banks, have been fighting this very hard. And on March 5th, the American Bankers Association actually rejected a White House brokered promise. And Trump also posted about this, as you can see here on Truth Social, accusing banks of holding this bill hostage. So why does this matter for a bull run? Because institutional capital hates uncertainty. Every major fund, every pension, every wealth manager sitting on the sidelines is just waiting for regulatory clarity before they can deploy or will deploy serious capital. On March 5th, the crypto industry gained its first access to the Federal Reserve payment system. Hong Kong is also issuing its first stablecoins licenses this month, and so we're seeing a global regulatory framework already emerging. If the Clarity Act passes in the next few months and the Treasury Secretary Bessent is pushing for a spring signing, we could actually see a flood of institutional participation here. The fourth trigger would be the on-chain conviction and supply dynamics. Let's take a look at what blockchain is telling us. Long-term holders, which are wallets that have held their Bitcoin for a year or longer, saw a selling collapse by 87% from early February to March 1st. Also, miner capitulation seemed to be ending. Peak miner selling hit 4.7 Bitcoin around February 8th, and by March 1st that dropped to just 840-ish Bitcoin. And when miners stop panic selling to cover operation costs, that also removes a major source of sell pressure. Usually a capitulation of these miners also indicates a bottom of a bear market. Here's a critical data point. Over 400,000 Bitcoin were accumulated between $60 and $70K during this recent consolidation. That creates what's called a structural density. When large amounts of supply chain hands in tight range, that range becomes psychologically and technically also important for TA, and it acts as a support. But the real supply story is on the exchanges. Exchange balances are at a multi-year lows. The coins are not moving as much anymore. They're being accumulated and moved to cold storage, or they're moved through ETFs. And when you combine decreased liquidity supply with institutional demands through ETFs, with miners holding, with long-term holders not selling, you create conditions for violent upside moves when this demand accelerates. The final trigger is the maturation of institutional market structure and RWA tokenization. This is about the market graduating from speculative retail cycles to more institutional-grade infrastructure. Of course, it wouldn't be a Web3 investing video without a Chainlink mention. Chainlink currently has facilitated over $28 trillion in transaction value. Major institutions like DTCC, Fidelity, and Signum are using Chainlink's infrastructure for critical NAV data and reserve verification for tokenized products. And of course, this is Wall Street building production-grade on-chain systems right before our eyes, with the tokenized real-world asset market also currently sitting around $2.2 billion. These institutions, they don't want volatility. They want these treasuries, money market funds, private credit with 24/7 settlement. They want reduced friction. They want transparency or transparent collateral, and all that in programmable ownership. And this is, of course, where Chainlink is one of the best in. And the more Wall Street tokenizes assets, the more infrastructure gets built, the more blockchain gets used, more capital flows on chain, and the more these rails, I guess, are being stress tested and legitimized. So where does that leave us? Looking at the data objectively, we are in some consolidation phase that could be a final accumulation window. We could go lower, of course, but on-chain metrics suggests that we are not yet on a cycle top, but it's crypto. Anything can happen. Of course, this is not financial advice. So we've talked about 5 triggers. They don't all need to be hit perfectly, but let's say 4 out of the 5, or even 3 out of the 5 align, and we get sustained ETF inflows, Fed easing, regulatory clarity, or an explosion in RWA, I think we would be ready for a powerful move. So yeah, let's pay close attention in the next 2 to 3 months, see where things are going, and monitor the situation well. Follow me for sure, that would help you, because I'll definitely make updates on anything that will happen. And if you have any suggestions or ideas for videos, please let them know, and I'll definitely look into them. Manage your risk, position yourself smart, and I think you should be fine. And just know that although markets are boring right now, things could go really, really fast once certain triggers trigger. So yeah, drop your comments below, make sure to subscribe, and I'll see you in the next video. Thank you so much for watching. Cheers, bye-bye.